The latest inflation data is in, and it turns out inflation is not going down the way everyone is hoping. And because of these higher than expected inflation numbers, the White House's Treasury Secretary Janet Yellen just came out and said that she was wrong and regrets that she said that inflation was transitory. It only took, 3 years? So here we are in March 2024, and we just got data saying that the prices of things that we buy rose faster than expected in February. But it gets a little worse. Wholesale inflation, which is when businesses have to pay more money to buy their raw products and materials, rose 2 times faster than expected in February. Now this is where you might be thinking, well, Jaspreet, it's a good thing I don't own a business. Well, you still want to pay attention. Think of it this way. If a business has to pay more money to create their furniture and toys and cars, who do you think is going to end up paying more money to buy these furniture and toys and cars in the future? Who, me? And this naturally brings us to 3 questions that I want to dive deeper into in this video. Question number 1 is, if inflation stays hotter than expected, when are we going to see interest rates actually fall? And number 2 is, if interest rates stay higher for longer, is that going to lead to an economic slowdown or a recession? And number 3 is, if inflation is hotter than expected, what does that mean for the cost of living for regular people in America in 2024? Are we going to continue to see this bigger divide between people who are wealthy and understand money and everybody else? So let me start by talking about number 1. What the heck is going to go on with interest rates if inflation is coming in hotter than expected? Now, I do want to let you know that on April 2nd, 2024, I'm going to be hosting a real estate investing workshop where I'm going to be going over my own real estate investing strategies, where I'll be going over things that I look for to find a good real estate location, how to find a good neighborhood to invest in, how to find growing areas, and then I'll be going over how to find a good property that makes sense financially, how do you underwrite the deal, how do you make sure that this property is going to cash flow, and then I'm also going to go over how you can maximize your profits. So if you've been thinking about investing your money in real estate, or if you want to know how you can do your next real estate deal maybe a little bit better, this is a free and live workshop that I'm hosting on April 2nd at 8:00 p.m. All you got to do if you want to join me is register, and I got the link for you down in the description below. Now, to really understand what's going on with interest rates and where interest rates are going to go in 2024, I think we need to back up a little bit and understand why the Federal Reserve Bank has been forced to raise interest rates so aggressively over the past couple of years. And I haven't given this full explanation in a little while because I talked about this a lot in 2020, in 2021, and 2022, but I think it's very important to understand this right now. See, the thing that so many people get wrong about inflation is that inflation isn't actually the prices of things rising. That is a consequence of inflation. Inflation is when the value of your dollars drop. And between 2020 and 2021, during the pandemic, the Federal Reserve Bank printed trillions and trillions of dollars to help stimulate the economy. Because remember, the government was passing these major stimulus programs, but the government wasn't sitting on trillions of dollars in their bank account. I mean, if there were, we wouldn't have this 30-some trillion dollars worth of national debt. So when the government was passing these trillions of dollars of stimulus programs to give out stimulus checks, to give out unemployment money, to bail out businesses, to give out these PPP loans, the government needed money to do that. And because they didn't have this cash, how did they do that? Well, they went to their friends at the Federal Reserve Bank, who is a central bank here in the United States, who has the ability to essentially create money out of thin air. So the Federal Reserve Bank printed these trillions of dollars, they gave it to the United States government, and then the government went and gave out this money to people, and they gave this money to businesses. Now the question is, what is the impact of this? Well, we were in a recession in 2020 and 2021. Some people called it the worst recession since the Great Depression. Yet at the same time, we were seeing luxury brands like Louis Vuitton break record sales and record profits in 2021 and 2022, which you might think is a little strange, which it is, because we were technically in a recession, but people are buying up these luxury goods like crazy. So the question you want to ask here is, why was the government spending all this money creating these stimulus programs? Well, they wanted to stimulate the economy. Now let's think about this for a second. What does it mean when the United States government wants to stimulate the economy? They don't want you to take this cash and put it in your bank account because that's going to stimulate your wealth. They don't want you to take this cash and put it into the stock market because that's going to stimulate your wealth. They don't want you to take this cash and pay off your debt because that's going to stimulate your wealth. They want you to stimulate the economy, which means they want you to take this $1,000 stimulus check that you got and they want you to go out and shop with it. Because when you take that $1,000 stimulus check and now you go to Gucci, you go to Louis Vuitton, and you go to Chipotle and you get the extra guac, well, now somebody else is getting that money because now these companies make that money, and now they have the ability to open up more stores, hire more people, and continue growing the economy, right? Our economic system runs on spending. The more money you spend, the more money somebody else makes. And we saw this huge boom in spending in the middle of this crazy recession where the economy shut down. Nobody's working, nothing's being produced, except, I guess, money. So now we have an economy where nobody's working, nothing's being produced, but people have the ability to spend. And not just people, businesses have the ability to spend. People got money in the form of unemployment checks, people got money in the form of stimulus checks, and businesses got the money in the form of grants and PPP loans. So now, businesses have money, people have money, nothing's being produced, but people and businesses are spending like crazy. So now, let's think about what that means. If I'm going out to a store and I'm buying the products in the store, but nothing is being produced to be sold in that store, because remember, the economy shut down, factories are shut down, or they're not being produced at the rate as they were before. Well, now you have this low supply of goods, but a lot of demand, because everybody has money, but there's nothing really being sold. So now we have a lot of people that want to buy something, but there's not many of this thing being sold. What happens to the prices of things? Well, naturally, the prices of things go up. So now, when the government is spending money that they don't have, and the Federal Reserve Bank is printing money they don't have, and people are getting money, well, now this creates more demand for products. This creates more shopping. This creates more spending. And the spending stimulates the economy, because now people have money in the bank, which they can now go out and spend. And now as spending happens, businesses are making money, and now businesses are seeing more sales, businesses are seeing bigger profits, and then because they don't have as much stuff, they got to raise the prices of their products, because now they're also struggling to get their raw materials. They have to pay more money to get their stuff. They have to pay more money for the labor. So now the prices of things start to go up. And now you have this inflationary issue, which is that the prices of things have risen very quickly over the last few years because, well, so many dollars have been created. The value of each individual dollar has gone down, causing the price of things to go up. I mean, remember, there's no finite amount of dollars out there. Our paper dollars, our money, is not backed by physical gold or some physical tangible asset. So now when you print more money out of thin air and it enters our economic system, the value of each individual dollar goes down, which means if you had $1,000 in your savings account in 2019, and now you have $1,000 in your savings account in 2024, that $1,000 in 2024 cannot buy you anywhere near as much as it could back in 2019. So now what we've seen happen is that the value of our dollars have dropped a lot. And this is where the Federal Reserve Bank begun raising interest rates in 2022 as a way to cool down inflation. Now, this is where I want to premise this, that the goal of the Federal Reserve Bank now is not to create deflation, is not to get the prices of things to fall. The Federal Reserve Bank wants to create something called disinflation. And what disinflation is a cool down inflation. That means they still want the prices of things to rise, they just don't want the prices of things to rise as fast as they were rising before. So now the Federal Reserve Bank wants disinflation. And this means now they want the prices of things to start rising a little bit slower. That doesn't mean we're going to go back to the 2019 prices. That means they want things to be more expensive this year than last year, but not a whole lot more expensive. The Federal Reserve Bank wants an inflation target of 2%, meaning they want the prices of things to rise by around 2% a year, but we're still quite a bit higher than that. This is where now understanding, well, the inflation issue was originally caused by the Federal Reserve Bank printing money and then the government spending money. And now to solve this issue, the Federal Reserve Bank is working to raise interest rates to solve the problem that they originally created. The problem with this is now raising interest rates have consequences as well. The Federal Reserve Bank has raised interest rates around 11 times since 2022. Now, what is the impact of these higher interest rates? Well, if you want to go out and buy a home, your mortgage rate is more expensive, so it's a little bit more expensive to go out and buy that home because your mortgage payments are so much more. Same with buying a car. I am not an advocate of you going out and financing a car, but the reality is many Americans are financing their cars. And if you have to finance your car at a 10% interest rate as opposed to a 3% interest rate, it's going to cost you more money for that same car because now the car costs more money and you have to pay more money to finance the car. And it's also a credit card debt. I'm not an advocate of you financing things on your credit card, but many Americans have credit card debt, and when interest rates are more expensive, you have to pay more money on your credit card debt just because interest rates are more expensive. So now, this is where the Federal Reserve Bank has been working to increase interest rates to do what? To do something called cooling demand. Because now, when interest rates are higher, people are looking at car prices, they're looking at the prices of things saying, I don't know if I can afford this anymore, so maybe I won't buy this. And now if you have less people out shopping, if you have less people out spending money, that means lower demand, while supply of things are going up because now manufacturing plants are opening back up, stores are opening back up, the supply chain systems are opening back up. So things are being produced and the supply of things are rising and the demand of things are coming down. This is how now the Federal Reserve Bank is working to cool down inflation because they want demand to come down. Higher interest rates cool down demand. Another way to understand this is just take a look at the housing market. When mortgage rates are at 7%, you have a lot less people that want to buy a home than mortgage rates are 3%. Because when it's a 3% mortgage rate, everybody wants to buy a home, every home is a bidding war, and now you have 50 offers on every single home. When mortgage rates are 7%, well, there's not as hot of a housing market because now people are questioning if they want to pay that much of an interest rate on their mortgage. So it's a way to cool down demand, and when mortgage rates are 3%, we saw home prices shoot up much faster than what they were doing now. So this is what the Federal Reserve Bank is doing. They work to increase interest rates as a way to cool down demand, as a way to cool down price growth. And this is where now the Federal Reserve Bank is having to make that decision of when do we start cutting interest rates? And the reason they want to cut interest rates is because a lot of people are saying, please cut interest rates so we can buy a home. Please cut interest rates so we can buy a car. Please cut interest rates so my credit card becomes cheaper. But the Federal Reserve Bank is also having to decide now, how do we cut interest rates and also keep inflation low? Because if we start cutting interest rates and mortgage rates go down, car rates go down, and people start buying things all over again, that can make the inflation problem worse again. And this is why the Federal Reserve Bank keeps saying that we want to see inflation steadily come down to the 2% target, which is what they keep saying, before they start cutting interest rates. When will that be? Well, nobody knows. The Federal Reserve Bank is hopeful that this will happen in 2024, but if you want my personal opinion, it is important for the Federal Reserve Bank to solve the inflation problem before they start worrying about interest rates. Because if we run into an inflationary crisis, a currency crisis, that's much more difficult to solve than the impacts of higher interest rates. Because the impacts of higher interest rates are, of course, number two, an economic slowdown. Higher interest rates hurt the economy. They cool down asset prices, they cool down businesses. Now you might be wondering, well, how does that work? Well, think of it this way. If you wanted to go out and buy a home that you like, you found this $500,000 home that's listed for sale, and now you have two mortgage options. One is a 3% mortgage, one is a 7% mortgage. Well, you might be willing to pay more money if it's a 3% mortgage because, well, it's going to cost you a whole lot less month over month over month versus the 7% mortgage. If it's a 7% mortgage, you might need a discounted price. And this is why, generally, higher interest rates cool down asset prices. But it's not just asset prices, it also has to do with businesses. Because if you're a business and you have debt, you're generally not getting a 30-year fixed rate mortgage. You're generally getting some sort of adjustable rate mortgage, which is going to readjust every few years. So now, lots of businesses, pretty much every business, refinanced their debt in 2020 and 2021 and maybe even into 2022 because interest rates were at their lowest levels in the history of America. So now businesses across the country were refinancing their debt. But now as those readjustments come due in 2024 and 2025 and 2026, well, interest rates are a whole lot higher today than what they were before, which means as a business, your costs to service that debt might be a whole lot higher today than they were a few years ago, not because you necessarily went out and took on more debt, but because interest rates are so much higher. So now we're in an environment where you have this tidal wave of commercial real estate debt that's beginning to readjust in 2024. And you also have this huge amount of corporate business debt that's starting to readjust in 2024. We have more debt readjusting in 2025, but it's starting in 2024. So now the question is, well, you have all these landlords and all these businesses that are going to see their debt levels readjust in 2024 and 2025 and 2026. If interest rates stay higher, what is that going to do for them? Well, that means their costs are going to rise. Now, generally what you do as a business or a landlord when your costs rise is you pass this cost down to your consumers. That's the way that our economic system works. When McDonald's has to pay more money for their stuff, they charge their consumers more money. That's how business works. If a business has to pay more money, they pass this cost down to the consumers. So now, if costs start to rise significantly because of their debt costs, that could mean that businesses have to go out and raise more money. They have to get more revenue. And that could be especially tough during a time where a lot of Americans are already struggling with their finances. For example, like I said just a minute ago, our economic system runs on spending. The more money you spend, the more money somebody else makes. Well, what we've seen up until today is that the American consumer is strong, which has kept the economy moving. Now, what does that mean? If the American consumer is strong, that means that Americans are spending money. But you have to pay attention to that with what's also going on the other end of the picture. Because what we're also seeing is right now we have broken a record for hardship withdrawals from 401ks. What does that mean? We're seeing a record number of Americans pulling money out of their long-term retirement accounts. That way they can continue paying for their groceries. And in addition to that, we also have a record amount of credit card debt in America today. So now, what does all this mean? Americans are spending money like crazy. Part of the reason why they're spending money like crazy is because they have to, because everything is so much more expensive. Rent is expensive, groceries are expensive, travel is expensive, cars are expensive. Everything is way more expensive than what it was before. Are Americans making more money today than they were 5 years ago? Yes. But has income grown as fast as the cost of living? Generally, for most Americans, no. So now we have a lifestyle today that costs more than it did a few years ago, where incomes generally have not risen fast enough to keep up with the higher cost of living. And so now many Americans, to keep up with their lifestyles, are pulling money out of their 401ks, or they're going into credit card debt to continue funding their lifestyles. This is now kind of causing those concerns of, well, are we going to see any issues in the economy? And more recently, what we have seen happen is this worry about the recession has kind of faded away. Part of the reason for that is because the stock market has been booming. Part of the reason for that is because crypto prices has been booming. Part of the reason for that is because the real estate market has been booming. So a lot of people are not really worried about that, but you also want to remember this. Nobody can perfectly time the economy. Nobody can perfectly predict when a recession is going to happen. That's impossible. I don't want you to do that. But I want you to also remember that recessions are a part of our economic system. Our economy goes through booms and our economy goes through down periods. That's just a fact. Our economy has gone through a recession pretty much every decade for the last century. And one of the kind of common themes before any recession is that recessions don't happen when everybody's predicting a recession to happen. Recessions generally happen when people don't think a recession is going to happen. Because when people don't think a recession is going to happen, they let go of all their money. They spend their money or they throw their money into investments, so they don't have that same money on the sidelines. When people are worried about a recession, they have a lot of money sitting on the sidelines waiting for any pullback. But you can't have a recession if everyone's just sitting on cash. And this is where you got to remember, there's been a lot of money created over the last few years, so there's a lot of money that had to be deployed. But this is where I just want you to also understand that there are risks in our economic system. Now, does this mean you shouldn't be investing your money, that you need to be worried about the economy? No. This means you got to be smart and just understand what's going on in our economic system, which also brings me to number 3, which is, of course, what's going to happen with the cost of living. Now, the thing that I want you to understand about this is, first off, inflation is a compounding number. The inflation that we're seeing in 2024 is on top of the inflation in 2023. And the inflation in 2023 is on top of the inflation that we saw in 2022. And the inflation that we saw in 2022 is on top of the inflation that we saw in 2021. Now, if you remember, back in 2021, this is when the White House came out and said that inflation is transitory. The Federal Reserve Bank said that inflation was transitory. It took until 2024 for everybody to say, oh, sorry, we were wrong about this whole transitory inflation thing. Well, inflation was not transitory, which means that the inflation has compounded year over year over year. And over these years, the average American has not seen their income grow year over year over year fast enough to keep up with inflation. Now, the big news that a lot of people like to talk about now is that in the tail end of 2023, reported incomes grew faster than cost of living. Reported incomes grew faster than inflation. This is good news. That means people were making more money than the cost of living growth in the tail end of 2023. But the full picture of that is people were losing money in 2021 and 2022 and most of 2023 because the cost of living kept growing faster than incomes. So yay, the cost of living grew slower than people's incomes in the end of 2023, but relative to the whole picture from 5 years ago, a lot of Americans are broker today than they were before. So now, if we continue to see this higher cost of living growth, which it will take time to bring inflation down, well, if your income is not growing fast enough to keep up with real inflation, because you got to also remember that reported inflation numbers are often not what many people feel. I mean, the reported grocery inflation for the last few years is around 22%, meaning in 2020 and today, $100 groceries should cost $122 today. Now, I don't know about you, but for me, a $100 grocery cart costs a whole lot more than $122 today if it cost $100 back in 2020. So just understand the reported inflation is a little bit different than what many Americans actually feel, but if your income is not rising fast enough to keep up with inflation, then you are reportedly becoming poorer year after year after year because of the inflation. And this is where now it is so important for you not just to be a consumer with your money, but to also be an investor, because at the same time, well, investors have become extremely rich over the last few years. Because people that were buying stocks in 2019 and 2020 and 2021 have made huge returns. People that were invested in real estate made huge returns. People that were even buying cryptocurrency. Now that is a speculative asset. I'm just talking relatively here. People that were buying cryptocurrency have also seen a lot of huge returns. This means that for you to actually build wealth in this economic system, you can't just make money and spend money. You have to make money and invest money, which means you cannot spend all your money. Now, the reason why that's so difficult, because that means you can't spend all of your money during a time where everything is keep getting more expensive. That means you gotta stop spending some money so you have more money to invest. That requires first step financial discipline, and then you gotta learn how do you actually invest this money. Now, there's a lot of different ways to invest your money. I mean, you can put your money into the stock market, you can invest your money into real estate, but I want you to understand a couple things. Number one is that investing is a long-term game. We could see a recession in 2024 or 2025 or 2026. If we see a recession and markets go down, you could lose money temporarily, but you gotta remember, you don't actually lose money until you sell. And that means you gotta have the psychology to withstand market ups and downs. Because guess what? The market goes up and it goes down. Nobody knows what the stock market's gonna do in 2024, 2025, and 2026, but if you're 35 years old, well, now you should be investing with a 30-year investment span, not with a 6-month investment span. So the first thing you gotta understand is you gotta have this long-term mindset and understand the markets will go up and down. And when markets go down, that's not a time for you to panic and sell off and just run away. That's a time for you to buy more aggressively, because those create huge investment opportunities. When the 2020 pandemic hit and the markets were crashing, I was out buying stocks like crazy. When the 2008 real estate market crashed, I was out and buying real estate. These create investment opportunities for those who are financially educated. Then the second thing is, well, what should you be buying? Because the mistake that a lot of people make is, well, if I bought a bad asset, it could go bankrupt, which is very true. But this is where you want to understand how do you invest your money into the right assets. That way you can have the right diversification to protect you, because if you're not investing in the financial education to understand how do you have a good asset versus a bad asset, well, now you could be investing your money into the next Sears, which of course was a great stock until it went bankrupt. So this is where understanding, well, you could also just invest your money into the stock market, or understanding how to invest your money in real estate, which of course, I have my real estate workshop coming. If you want to join, it's free. I got the link for you down in the description. But the whole idea here is you got to understand that you need to be an investor. And if you want to be a successful investor, this is where you need to be investing in your financial education. That way you know how to invest your money. That way you can win when markets are up and when markets are down, because markets go up and down. And this is where you got to understand that nothing can go straight up forever. And most things don't go straight down forever as well. But this requires you to understand what's going on, that way we can capitalize on the way that our economic system works. Well, by the time 2023 came around, sustaining that type of spending in the United Kingdom became even more tough, because now you have the cumulative effect of the high inflation, and that's where you saw more banks having to write off these bad loans, these bad consumer debts, because people weren't able to pay off their debts. And that was about the time where it was declared that the United Kingdom is in a recession.